Welcome back to another edition of Talk Pickers. This is the show where we don't just read the headlines, we perform the autopsy.
Yeah, the professional earnings call summarization show.
Exactly. We take the noise of the market, filter out all that PR spin, and really just turn it into pure, actionable signal for you. I'm your host, the guy who asks the questions that you are probably screaming at your terminal.
And I'm the expert. I'm the one who actually, enjoys reading the footnotes on page 47 of the 10K so you don't have to.
Which we appreciate. So today, we have a very special mission. We are stepping behind the yellow tape. We are looking at it's a crime scene. We are doing a deep dive into the Q4 2025 earnings call for Chemours. Ticker symbol CC.
Crime scene is honestly barely a metaphor today. It feels quite literal.
If you looked at your portfolio this morning, or if you just glanced at the ticker tape rolling across the screen, you know exactly why we are talking about this company.
Right. The market reaction was visceral. It was immediate. We saw a negative 16.5% drop intraday.
Intraday. And that wasn't on light summer Friday volume either, right?
The volume was massive. They traded 11.4 million shares against a typical day of maybe 4 million.
That is nearly 3 times the normal volume.
Yeah.
That is capitulation. That is investors just running for the exits, trampling each other to get out the door.
It really is.
Yeah.
That represents institutional liquidation. You do not get that kind of volume from retail traders panic selling on their phones.
Right.
That is funds dumping blocks. That is portfolio managers saying, I do not want to explain this position to my investment committee tomorrow morning. Get me out.
Blood on the streets. And what is fascinating to me, and we are going to unpack this for the next hour because this deep dive really deserves it, is that this isn't just a story about a company missing a number.
No.
It's not just, we sold fewer widgets this quarter. It is a story about a complete identity crisis. It's a tug of war between two completely different realities living inside one single corporate body.
That is the perfect way to frame it. It is a tale of two companies. It is Dr. Jekyll and Mr. Hyde.
Right. Because on one side of the rope, you have this dazzling, futuristic narrative. You have AI data center cooling.
Yep.
You have partnerships with Samsung. You have liquid immersion technology that sounds like something straight out of a sci-fi movie. It sounds like a high-flying tech stock.
Exactly. That is the growth engine. That's the Thermal and Specialized Solutions segment, or TSS as they call it. That is the dream.
But then you turn around, and on the other side of the rope is the grim reality of an old-school industrial chemical company. You have frozen pipes in West Virginia. You have power outages.
The nightmare.
Massive earnings misses. You have inventory piling up in the warehouse like it's an episode of Hoarders.
And that is the cyclical anchor dragging the whole ship down. That is the legacy business. So the big question we're trying to answer today, the mission of this deep dive, is Chemours a misunderstood transformation story that is about to become the next darling of the AI trade? Or is it just a cyclical dinosaur trying to wear a tech disguise?
I love that image, a dinosaur in a Steve Jobs turtleneck. It is trying to present as Silicon Valley, but the bones are still Jurassic. Okay, let's get into the numbers. We have to start with the snapshot, the headline numbers, because this is where the pain really started.
The headline numbers were tough. There was absolutely no way to sugarcoat it. Let's look at the earnings per share, the EPS.
Let's do it.
On a GAAP basis, that is generally accepted accounting principles, the real unadjusted number, they lost 31 cents per share.
Wow.
That is a net loss of $47 million for the quarter.
Losing money is never a great look. But Wall Street usually looks at the non-GAAP number, right? The adjusted number where they strip out the one-time bad stuff. How did that look?
Better, but still a miss. Non-GAAP EPS came in at 5 cents, a nickel.
Okay. And expectations.
The consensus expectation from analysts was 7 cents, so they missed by 2 pennies.
Now, I can hear you listening right now saying 2 cents. Who cares about 2 cents? But explain the psychology here. Why does a 2-cent miss cause a 16% drop?
Because when a stock has run up, and remember, Chemours had run up significantly before this earnings call at his price for perfection.
Right.
A 2-cent miss on a base of 7 cents is nearly 30% miss. It signals that your forecasting is broken. It signals that management doesn't have a handle on their own business. In this game, a miss is a mile. It completely shatters confidence.
It is not the magnitude of the penny. It is the magnitude of the error in judgment. What about the top line? How is revenue?
1.3 to $9 billion. That is down 2% year over year. It was a slight miss against expectations. But the real kicker, the number that I think drove the sell-off more than anything else, was the adjusted EBITDA.
EBITDA, earnings before interest, taxes, depreciation, and amortization, the proxy for operational cash flow, the number the bankers love.
Correct. It came in at $128 million. That is down 24% year over year.
24%.
When your operational earnings drop by a quarter, the market is going to punish you severely. It suggests operating leverage is working against you. Your costs are fixed, but your sales are falling, so your profit just evaporates.
Okay, so the stock closes at $17.04, down 16.5%. But here's where it gets interesting to me. Management, specifically CEO Denise Dignam, they didn't come out and apologize on the call. They actually tried to flip the script.
They did.
They pushed a silver lining.
They leaned very heavily into free cash flow, FCF. They reported positive $92 million in free cash flow for the fourth quarter.
Okay.
Denise's framing was essentially, ignore the earnings miss, look at the cash we generated.
Yeah.
This is more reflective of our long-term potential.
It is a bold strategy. Hey, we didn't make much profit, but we squeezed some cash out of the system.
It is very bold. And to be fair, generating $92 million in a single quarter is a decent number for them. It shows they can manage working capital when they really need to. It shows they can twist the arm of their suppliers or delay some spending.
Sure.
But the dynamic here is clear. I look at that cash and say, okay, that buys you time. That pays the interest on the debt. But the market looked at that cash and said, we don't care.
Yeah.
Your operations are stumbling.
Right. You can liquidate inventory to generate cash, which is largely what they did, by the way, but you can't cut your way to growth forever. It is like selling the furniture to pay the rent. Eventually, you run out of chairs.
Exactly. The market ignored the cash cushion and focused entirely on the operational mess. And frankly, they were right to do so. Cash flow is the result of operations. If operations are broken, cash flow eventually dries up entirely. You cannot financial engineer your way out of a broken factory.
So the market verdict was swift. But to understand why the operations are broken, we have to dissect the company segment by segment. Because this isn't just one business, it's three businesses in a trench coat. Let's start with the hope. Let's start with the golden child.
Segment 1, Thermal and Specialized Solutions, or TSS.
This is the part of the earnings call where if you just listened to this section and ignored literally everything else, you would think the stock was up 20%. This is the only part of the business that is effectively growing.
It is. Revenue for TSS was $444 million, up 14% year over year. That is double-digit growth in a sluggish industrial environment. That is standout performance.
And the absolute star of the show is Opteon.
Opteon is their brand for low GWP refrigerants. GWP stands for global warming potential.
Right. So these are the eco-friendly refrigerants. Let's explain the science briefly so you understand what we're looking at. Why does the world need Opteon?
It comes down to the molecule itself. The old stuff, hydrofluorocarbons or HFCs, they are incredibly potent greenhouse gases. Some of them are thousands of times more potent than CO2 at trapping heat in the atmosphere.
Bad news.
Yes. Opteon is an HFO, hydrofluorophene. It breaks down much faster in the atmosphere so it doesn't trap heat. It solves the environmental problem without sacrificing the cooling performance.
And Opteon specifically was up 37% year over year. That is a massive number.
37%.
Yeah.
That is tech growth. That is software growth numbers. That is not chemical industry growth.
Well, what is driving that? Is everyone just suddenly waking up, deciding to be eco-friendly and buying new air conditioners?
It's less about choice and a lot more about force. It's a combination of two things. First, you have the regulatory hammer. The AIM Act in the United States.
The AIM Act, we have mentioned this before on previous deep dives. This is the legal mandate, right?
Yes. The American Innovation and Manufacturing Act. It mandates a phase down of HFCs. The government is essentially restricting the supply of the old stuff, making it incredibly expensive and scarce, and forcing the industry to switch to the new low GWP alternatives.
I see.
Chemours owns the IP. The intellectual property for Opteon, which is the leading alternative. So if you are an HVAC manufacturer, a Carrier, a Trane, a Lennox, you don't really have a choice. You have to buy this stuff. That is a legal mandate driving your sales.
That is the best kind of moat. The government literally says you have to buy my product.
It is incredibly powerful. We saw strong adoption in stationary HVAC, particularly residential systems, as they gear up for these regulatory deadlines. This is the bedrock of the segment. It provides this steady cash flow. But that's not the sexy part of the story. That's just the steady part.
No, the sexy part is the data centers.
The AI narrative.
Yeah.
Management leans so hard into this on the call. They dropped the words data center and AI every single chance they got. It was clearly part of the script to make sure the algorithms picked it up.
Break this down for us. Why does AI need Chemours? Why does ChatGPT need refrigerant?
Heat. It is all about heat density. High-density compute, the kind of chips NVIDIA is making, the Blackwell chips, the next-generation stuff, they run incredibly hot. We are talking about chips that consume 700, 800, even 1,000 watts of power per chip.
That is like a hairdryer running inside a tiny microchip.
Exactly. And if you have a rack of these things, traditional air cooling where you just blow cold air with a fan is reaching its absolute physical limit. Air is an insulator. It is not great at moving heat. It's inefficient, it's loud, and it just can't remove the heat fast enough to keep the chips from melting.
And if it gets too hot?
If the chip gets too hot, it throttles down and you lose performance, defeating the whole purpose of buying the expensive chip.
So you need something better.
You need liquid cooling, specifically immersion cooling. This is where you literally submerge the server rack in a bath of non-conductive fluid.
It sounds insane to submerge electronics in liquid. Usually if I drop my phone in water, it's game over immediately.
Right, but this is dielectric fluid. It does not conduct electricity. You submerge the board, the fluid touches the chips directly. It boils on the surface of the chip. That's called two-phase immersion cooling. The boiling action whisks the heat away incredibly efficiently. It's the most efficient way to cool high-performance computing.
And Chemours makes the liquid.
They make the two-phase immersion cooling fluid. And they announced some very specific wins on this call to prove it wasn't just vaporware. They announced the qualification of their immersion cooling fluid by Samsung Electronics.
Samsung. That is a massive name to drop. That is a tier 1 player.
It is validation.
Yeah.
It means the tech works at scale. It means Samsung has tested it in their labs, run it through the ringer, and signed off on it. This moves it from science project to commercial product. They also announced a manufacturing agreement with a company called Navin Fluorine to start commercial production in Q3 2026.
So they are building out the supply chain. This is real.
It is real. And this segment, TSS, is the exact reason the stock ran up before earnings. If you look at the chart, Chemours was up 63% in the 3 months leading up to this call.
63% in 3 months. For a chemical company, that is practically unheard of.
It happened because the market started pricing it as an AI adjacency play. The narrative was, this is the NVIDIA of refrigerants. They saw the growth, they saw the patent portfolio, and they bought the dream entirely.
But then reality hit.
The insight here is crucial. When a stock runs up 63% on a narrative, it is priced for perfection. 37% growth in option is amazing. It's incredible. But because expectations were so sky high, it wasn't enough to offset the total disaster of the rest of the company.
It is like getting an A+ in art class but failing math and science. You still flunk the semester?
Precisely. The market priced in the AI dream but completely forgot about the industrial nightmare.
Let's talk about that nightmare. Let's talk about the problem child. Segment 2, Advanced Performance Materials, or APM.
This was the earnings crater. This is where the P&L went to die. Net sales came in at $312 million, down 4% year over year. But the EBITDA was $12 million.
$12 million for the whole segment.
Down 74% year over year.
That is a collapse. That is a total margin implosion. How does a business unit lose 74% of its profit in one single year? What happened?
A disaster at Washington Works.
Washington Works? That sounds like a government agency, but it's their big factory, right?
It's their flagship manufacturing site in West Virginia. It is a massive, sprawling industrial complex. And the story here is almost hard to believe. They had a disruption in January. The cause was traced back to equipment affected by a local utility outage last August.
Wait, hold on. August? That was 5 months before the quarter even ended.
Correct. They had a power outage in the summer. It damaged some very sensitive equipment. These are complex chemical processes. We are talking about fluoropolymers. You can't just flip a switch to turn them back on. The molten polymer travels through miles of heated pipe. If the power cuts, the heat stops.
Oh, no.
The polymer freezes. It turns into a solid rock inside the pipe.
That sounds like an absolute nightmare. You have to physically clean that out.
Often, yes. Or replace the equipment entirely. So they were limping along, trying to fix the damage from August. And then in January, during the restart attempts, they got hit with a severe freeze, a major winter weather event.
So it was a cascading failure. A summer outage weakens the system, and a winter storm delivers the final knockout blow.
Exactly. And the impact was severe. The plant shut down. Capacity was limited. They literally couldn't make the product. The financial hit is estimated at $20 to $25 million negative impact on Q1 earnings alone. That is money straight out of their pocket.
That is huge. And here's the irony, and I want you to confirm this because this connects back to the AI story we were just talking about.
Sure.
This segment, APM, makes high purity PFA, right? Perfluoral alkoxyalkanes.
Yes, they do.
And high purity PFA is used in semiconductor manufacturing.
It is essential for it. It's used in the tubing, the piping, the valves, the carriers that handle the ultra-pure chemicals used to etch the chips. You cannot build a modern fab, you cannot build a Blackwell chip without this stuff.
So listen to this absolute tragedy. We have the golden child, TSS, selling cooling to data centers for AI. And we have the problem child, APM, supposed to be selling materials to make the chips for AI.
Yes, they are played on both ends of the AI boom.
But because of frozen pipes in West Virginia, they can't make the product.
That is the tragedy. Just as semiconductor demand is showing signs of life, we heard them say demand is picking up in semi, the cycle is turning, they physically cannot make the product to sell into it. This kills the momentum. It makes them look unreliable to customers who need 100% uptime.
Yeah, if you're a major fab.
If you are Intel or TSMC, you cannot have a supplier tell you, sorry, my pipes froze. You will qualify a second source immediately.
That is so frustrating. It's one thing to have no demand. It's another thing to have demand and fumble the ball on the 1 yard line.
And that is why the stock dropped. Operational unreliability is a valuation killer. The market hates uncertainty, and Washington Works has become a source of constant uncertainty.
They also mentioned some strategic exits in this segment. They are closing a site in France.
Yes, the Villers-Saint-Paul site. It was intended for hydrogen development, another future growth narrative that they are now just scrapping entirely. They realize the hydrogen economy isn't developing fast enough to justify the cost.
Right.
They're also exiting the SPS capstone business in 2025.
Yeah.
This creates a revenue hole. They are losing sales, and they are trying to fill that hole with higher margin products. But when your main factory is down, filling that hole becomes very difficult.
It's like trying to remodel your kitchen while your house is actively on fire.
Okay, so APM is a mess. Let's move to segment 3, the heavy anchor. Titanium Technologies, or TT.
The biggest segment by revenue and by far the most cyclical.
Titanium dioxide. The white pigment. It's in paint, it's in plastic, it's in paper. It's basically a proxy for the global economy. If people are buying houses and painting them, TT does well.
And right now, they are suffering. The global industrial economy is soft. Housing in China is a disaster. Europe is slow. Net sales came in at $561 million, down 11%. EBITDA was $23 million, down 67%.
Down 67%, another massive drop. That is painful leverage.
It's the depths of the cycle. But there is a specific strategy here that you need to understand. Management is calling it value over volume.
Explain that game theory for us.
In a commodity market like TiO2, you usually have two choices when demand drops. You can cut your prices to try to steal market share from your competitors, get more volume at a lower price. This usually triggers a price war where everyone loses money, right? A race to the bottom.
Or you can hold your price steady, refuse to discount, and accept that you will just sell less volume.
And they chose the second option.
They did. They refused to drop prices to chase market share. The result, pricing was flat to stable. In this deflationary environment, that is technically a win. They preserved the value of the product. But the cost of that win was that volumes dropped significantly.
So they kept their dignity, but they lost their sales.
In a way, yes. They are betting that when the market turns, they will be in a much better position because they didn't debase their pricing. But in the short term, it really hurts earnings. They are also taking drastic operational changes to compensate. They are idling a mine in North Florida.
Idling a mine, that sounds expensive.
It saves cash on operations, but it means you have a massive asset sitting there doing nothing. They're also transitioning to third-party earth-moving contractors. Basically, they're trying to variabilize their costs. Instead of owning the bulldozers and paying the miners full-time, they hire a contractor so they can fire them if demand drops again.
Ruthless efficiency, but necessary when you're down 67%. However, amidst all this gloom and TT, there is one beacon of light. One financial engineering savior that, frankly, might have saved the company from a much worse fate on this call.
The Kuan Yin sale.
This is the facility in Taiwan, right?
Yes. They closed the TiO2 production site in Kuan Yin, Taiwan, a while ago. But they still own the land and the physical assets. They announced on this call that they have finally sold it.
And the number?
Net proceeds of approximately $300 million.
300 million cash. That is not chump change. That is a serious injection of liquidity.
It is a absolute lifeline, and they were very clear about the use of funds. 100% earmarked for debt reduction.
Why is that so critical right now? Why are they so laser focused on debt?
Because their balance sheet is stretched. Net leverage is around 4.7 times EBITDA.
4.7x. That is getting into the danger zone.
It is high. For a cyclical company entering a downturn, you generally want to be below 3x, maybe even below 2x. At 4.7, you start worrying about debt covenants. You start worrying about credit rating downgrades. If you get downgraded to junk or deeper into junk, your cost of borrowing explodes. This $300 million sale brings that leverage down immediately. It buys them vital breathing room.
So they sold the furniture to pay the mortgage.
Essentially.
Yeah.
But it was unused furniture. It was a smart move. Without this sale, the narrative on this call would have been much, much darker regarding their solvency. The analysts would have been asking about bankruptcy risk. The Kuan Yin sale took that right off the table.
Okay, so let's recap the board so far. We have the tech savior, TSS, the operational disaster, APM, and the cyclical anchor, TT, that just found a bag of cash in Taiwan. Now let's talk about the mystery, segment 4, the inventory and cash mystery.
This was the most tense part of the Q&A with analysts. It was practically an interrogation.
I noticed the tone shift too. The analysts were looking at the balance sheet and just scratching their heads. Here is the fact pattern. Revenue is up about 5% since 2019, but inventory is up 50%.
From $1.1 billion to $1.6 billion.
That is $500 million of cash trapped in warehouses, sitting on pallets, doing nothing. Why? Why are they hoarding stuff?
Management's defense was complicated. They blamed take-or-pay contracts for ore.
Take or pay? That sounds like a mob deal. You take the ore or you pay anyway.
It is common in mining. When you buy titanium ore, the raw dirt, you sign long-term contracts with the big miners like Rio Tinto. They need guaranteed volume to justify digging the hole in the first place. So the contract says you must buy X tons per year. If your sales drop and you don't need the ore, too bad, you still have to buy it.
So they are being force-fed raw materials they don't even need.
Exactly. They said one contract is ended, but one is still running. So they are buying high-grade ore, putting it in a pile, and burning cash to do it. They admitted they are carrying too much inventory and have stretch goals to reduce it.
And this connects to their cash flow target, right? They have a big goal for fiscal year 2026.
They do. They are targeting free cash flow conversion of greater than 25%.
How do they get there if they are spending all their money on a mountain of dirt?
By burning down that inventory. If the contract ends or they can negotiate some relief, they stop buying new ore and just use the pile they already have. That releases cash, it converts the dirt back into dollars, and by getting the Washington Works plant back online so they can actually sell the PFA they make.
But the market is skeptical.
Deeply skeptical.
Yeah.
When you have a history of operational mishaps, outages, fires, litigation, the market discounts your promises. They see the inventory bloat not as a savings account, but as a clear sign of poor management. They doubt their ability to convert earnings to cash efficiently.
Okay, let's zoom out. We have looked at the past. Let's look at the future. Investor context, guidance, and the macro picture.
This is where we got the hangover and the promise.
Let's start with the hangover. Q1 2026 outlook.
It was soft, very soft. They guided for EBITDA of $120 million to $150 million.
That's low. That is essentially flat to the disaster we just saw in Q4.
It is. The reasoning is the Washington Works outage, that $20 to $25 million hit we talked about, plus seasonal weakness in TT Minerals. They expect a 60% sequential drop in mineral sales.
Ouch. And cash flow for Q1.
They expect a use of cash, an outflow of up to $100 million.
So they are actively burning cash in Q1. That is not the start to the year investors wanted to see.
No, but then they pivoted to the promise, the full year 2026 outlook.
This is the, trust me, it gets better part.
Exactly. They are guiding for full year EBITDA of $800 million to $900 million.
Wait, let's do the math on that. If Q1 is around $135 million, the midpoint, and the full year is $850 million, that means they have to ramp up massively in Q2, Q3, and Q4.
It implies a very steep recovery curve, like a hockey stick. They're projecting revenue growth of 3% to 5%, and they're targeting leverage to drop below 4.0x by year end. Long term, they want it below 3.
Do you believe it?
That is the show me story. The stock is in the penalty box right now. Investors are tired of the excuses. Every quarter, it's something else. Litigation last year, power outages this year. The AI cooling growth in TSS is real. It is genuinely exciting. It's a diamond. But right now, that diamond is buried under a pile of titanium ore and frozen pipes in West Virginia.
The diamond is being suffocated.
Until they fix the operations in APM and stabilize the cycle in TT, the market simply refuses to give them credit for the diamond. The market is saying, prove it. Fix the pipes, sell the ore, generate the cash. Then we will talk about your AI multiple.
Which brings us to the most fun part of the show. We have analyzed the crime scene. Now, let's try to profit from it. It is time for our This Is Not Financial Advice segment.
Disclaimer time. We are not financial advisors. We are just two voices doing a deep dive. Do not trade based on what we say. This is for entertainment and hypothetical analysis only.
Exactly. Do not sue us. But imagine we are hedge fund analysts pitching to the investment committee. I have a trade idea for you. I call it the thermal separation arbitrage.
Fancy name. Sounds expensive. What is the setup?
The thesis is simple. The market is currently valuing Chemours as a broken chemical dinosaur. It is assigning zero value, or maybe even negative value, to the high-growth AI cooling business because it's trapped inside this messy conglomerate structure.
That seems accurate. The multiple is highly compressed. It's trading like a commodity stock, not a tech stock.
So here is the play. It's a long-short strategy. Leg one. You go long Chemours, CC aggressively at these depressed levels, around the $17 range. You are buying the asset at a deep discount. You are essentially buying the optionality for free.
Okay, you're buying the dip. But that is risky if the cycle gets worse. If the global economy tanks, Chemours goes to $10.
That is where leg two comes in. You hedge. You short a pure play titanium dioxide competitor, something like Tronox, TROX, or a pigment ETF proxy.
I see. So if the global economy tanks and titanium demand falls further, your short on Tronox makes money. Tronox drops just as hard as Chemours. That profit offsets the loss on your Chemours long. You are neutralizing the cyclical exposure. You're taking the economy out of the trade.
Exactly. You strip out the macro risk, and what are you left with? You are left with the idiosyncratic catalyst.
The activist angle.
Bingo. With the Kuan Yin sale clearing up the balance sheet and paying down debt, the argument that the parts are worth more than the whole becomes undeniable. You are betting on a spin-off. You are betting that within 12 to 18 months, an activist investor steps in or management realizes they have absolutely no choice and forces them to spin off the TSS option unit as a standalone company.
That is the outrageous upside. Because if TSS trades as a standalone entity, think about it. A company growing at 14%, with 37% growth in its key product, selling directly into the data center AI boom. How does that trade?
It trades at a data center multiple. It trades at 15 or 20 times EBITDA. It trades like Vertiv. It trades like Eaton. It absolutely does not trade at the 5 or 6 times EBITDA that a legacy chemical company trades at.
So you unlock the value. You unleash the diamond.
You are essentially buying the NVIDIA of refrigerants for the price of a gravel pit. If that spinoff happens, the stock could double, and your hedge protects you from the industrial downside in the meantime.
It is a classic breakup trade, some of the parts. And given the frustration we heard on this call, the analysts grilling them about inventory and cash management might be running out of runway to defend the conglomerate structure. If they don't fix the stock price themselves, someone else will come in and fix it for them.
And that is exactly where the money is made, in the friction between what is and what could be.
It's wild, but it is plausible. It requires a lot of patience, but the logic holds up.
All right, let's wrap this up. Final recap for you listening at home.
Chemours Q4. A quarter of extreme contrasts. Record growth in cooling versus frozen operations in manufacturing. Truly a tale of two cities.
A $300 million asset sale saves the balance sheet, but the operations need to be fixed immediately. The clock is ticking on management. They bought time, but they didn't buy forgiveness.
The AI story is real, but it is not enough to carry the dead weight of the rest of the business right now.
We will be watching Q1 very closely to see if those pipes are thawed, if that inventory pile is shrinking, and if they can actually deliver on those big promises.
Indeed. The burden of proof is entirely on them.
So, to leave you with a final thought to mull over, the next big tech monopoly isn't a chip designer, but the company that owns the patents to the only fluid that stops those chips from bursting into flames. And what if they're currently disguised as a struggling paint pigment supplier? Thank you for listening to Talk Tickers. Check your risk tolerance, do your own research, and remember, in the market, nothing is ever as good or as bad as it seems. Except maybe frozen pipes. Those are just bad.
Agreed. Signing off.
See you on the next deep dive. Goodbye.